Hello, everyone, and welcome to the Simply Financial Podcast. I'm today's host, Brett DiPasquale. Today, we're going to be talking about a problem that some investors don't know that they actually have. This is going to apply mostly to 20s, 30s, and 40-year-olds who are actively working, actively contributing to their employer retirement accounts, and just wondering, how do I build enough wealth so I can retire and live comfortably? The main thing on people's minds nowadays is contribute to your employer retirement account, get your match, put away as much money as possible, also get some tax benefits in the process. Now, that's a great foundation. But really, when we look at this, we need to look at it from a different lens or a different perspective. Having the amount of time that 20s, 30s, and 40s have until they actually do retire puts them in a situation where the federal government is going to be after them when they start drawing their money out, potentially. So by putting money away into your 401k, a traditional IRA, or any type of tax deferred instrument, you're getting a tax break now. You're investing that money, it's growing over a long period of time. And then as that money grows, what you're really doing is creating a big tax bomb for yourself. The federal government's just licking their lips to get your tax money whenever they possibly can. And the amount of money that you put in to the amount of money that your accounts have grown to over that period of time makes that even more lucrative in tax money that you'll have to pay. So the one question I get from younger clients is, well, how much should I put away? What should my return be? What should I be invested in? I want to make as much money now as I possibly can. That's great. That's a great perspective. My answer to that is you have time on your side. You're going to be invested generally at a pretty aggressive rate because of the time frame that you do have. But the bigger question is, how do we avoid the tax situation that is imminent once you do decide to start drawing on this money? It's not a now question, it's a later question. So by doing that and starting to solve that issue, we really take a look at three main things. Number one is a Roth IRA or a Roth 401k. Number two is going to be an individual taxable investment account. And number three is going to be some type of cash value life insurance. Now, all these solutions might not be right for everyone, but I just wanted to highlight each one briefly, just so you can get that picture stirring in your mind. So let's go over the Roth IRA first. So most people know how a Roth IRA works, but as an overview, with a Roth IRA, you can make a Roth contribution for up to $7,500 per year if you're under the age of 50. That number increases to $8,600 a year over 50. For today's discussion, we're going to stick with the $7,500 number because we're targeting and talking about younger investors. Now, to qualify for this, there are income limitations. So if you're a single taxpayer, your gross income has to be under $153,000. For a married couple, that number goes up to $242,000. That's your modified adjusted gross income. So what that means is whatever you make is your top line before any deductions that you have. So if you're over those income limits, a Roth contribution may not apply to you. If you're under those income limitations, they would. So you're eligible to make up to a $7,500 contribution per year into your Roth IRA and have that money grow tax-free over a lot of your working career until you're past the age of 59 and a half. The other option is going to be utilizing an employer Roth 401k. So some employers will give you this option next to your traditional 401k. So the traditional 401k will give you the tax benefit now, but it will not give you the tax benefit later. By doing the Roth IRA, Roth 401k now, you will not get a tax benefit now, but a huge tax benefit down the road. So if you have that eligibility in your plan, take a look at it. If you have any questions, feel free to reach out and ask us. but a very, very good option. Even splitting your contributions between Roth and traditional will help your overall tax situation long term. The second type of account we'll go over is your individual taxable investment account. So think of this as like a bank account that holds securities. So it holds stock, it holds bonds, it holds ETFs, mutual funds, fully liquid to you. You can draw your money out at any time, but you will be subject to capital gains. So let's say you buy a stock for $1,000. That stock rises up to $1,500. You sell the stock, you would owe capital gains tax on the $500 gain when you sell the security. What this does is this gives you flexibility, number one, to have access to your money. Number two, to pay capital gains tax, which is generally less, depending on your income, than federal and state income tax. And really, the money can be earmarked for, let's call it a medium length goal. So maybe you want to buy a house in 5 years. Maybe you want to send your children to school with some extra cash and you're not utilizing a 529 plan. Perfect example. Maybe you want to use it as your vacation fund every year rather than using a bank account. Also a really good idea. So the taxable investment account really gives you the ability to build your wealth at a lower tax rate generally than federal and state income taxes. You can put as much into it as you want to per year. There is no income limitations. There's really not many limitations at all around this. Like I said, think about it as a longer term savings account. The third thing we'll go over today is cash value life insurance. Now, this isn't going to be for everyone, but at the same time, it's worth a mention. Cash value life insurance is going to come into play when you have a couple things going on. Number one, you have a life insurance need. So you want to protect your family against your untimely death for income purposes, protecting your income, protecting your mortgage, and protecting any legacy planning that you want to do. Over time, the life insurance will build cash value, which can be borrowed from tax-free. Now, very important to note, a plan like this has to be structured correctly. It has to be funded correctly. It has to be taking into consideration all your needs, your life insurance need, your cash value need, and also working into what your income bracket is. So these can get expensive, but think of this as another leg of the stool when you're looking at tax planning. Get this question a lot when clients make over the Roth IRA limit. They don't have access to a Roth 401k, but they still want some tax benefit down the road. Life insurance could be a good option at that point. Over the long term, it'll build up a nice cash value for you. Money comes out federally and state tax free. So those three options are really good. Be sure to look into each one of them individually. And if you have any questions, you can feel free to reach out. But when you're looking to build your wealth, the main takeaway from today, I want to be clear, is not how much can I earn, how much can I contribute. It's where you should contribute it and what is the taxable consequence either now or later. If you have any questions about these, please feel free to visit our website, reach out to our office directly. Be glad to clarify some things for you. But until next time, I hope you have a wonderful day and look forward to seeing you on the next episode of Simply Financial.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.